Hi, I'm Russ Mayfield, investment strategist at Baird. We are back for another weekly update with our friends at Strategas. Today, we are lucky enough to be joined by senior investment strategist Ryan Grabinski to talk all things markets. Ryan, how are you doing today?
I'm doing well. How are you? It's a little cold here in New York, and I understand that there's snow across most of the country, but we're fortunate enough to not have it.
Yeah, we're dealing with a little weather down here in Kentucky, but nothing too bad. Just a little cold. Let's start with the market reaction to this recent earnings season. You know, we talked about this last time we talked. It's been a pretty good earnings season. We don't need to belabor that point, but two things that I think you've pointed out are worth mentioning, which is one, the analyst estimate for 2025 earnings is finally starting to tick down a little bit. I wondered if you could expound on why you think that's happening. And then two, just in your research, how companies are thinking about and responding to all the policy uncertainty that comes with the new administration.
Yeah, certainly. To the first point on earnings, 4Q has been outstanding to say the least. Growth is looking at something along the lines of 15%, depending on the day, and there's really only one company that can really have a significant sway to that. That's left to report, and that's Nvidia. So, all in all, it looks like 4Q is going to wrap up to be a strong quarter. 25 is starting to see some downward revisions. At the beginning of the year, growth was expected to be about 13%. That's come down to about 10% now. One of the things that I'm noticing is that margin, that elevated margin level that had been forecasted has also come in. So I think that's part of the reason why the earnings estimates have come in some here. You're also starting, at the end of the day, you also have companies have the cover to bring down their outlooks, just given all of the policy uncertainty that's happening in Washington. So they're certainly taking advantage of that as well. I'd say the biggest hurdle that I'm kind of hearing about when I listen to what companies are telling me is that the amount of policy uncertainty at Washington right now is a strain on their businesses. Frankly, they just don't really know the direction that that tariffs are going to go. One day they're 25%, the next day they're not even on the table. So the fact that the administration changes their mind from one minute to the next is certainly weighing on business sentiment. We haven't really seen, we haven't seen like the consumer really pull back. We did get, a weak retail sales most recently in January, but that's not all surprising coming out of the holiday season. Walmart, for example, today, they talked about how they had expected the consumer to weaken, but that really hasn't been happening either. So all in all, things are holding up pretty well, and it really, to me, it's just this policy uncertainty is weighing on corporate sentiment right now, and perhaps maybe that's starting to have investors rethink some of the stretch valuations that they're paying for some of these companies, in particular the ones that are trading at 40, 50, 60 times sales that had been driving the market higher.
Yeah, I think you hit the nail on the head, right? Businesses just want to know the rules of the game. That's a big part of why election years tend to see higher uncertainty is they just want to know what the rules of the game are. So certainly you can probably see some of those higher expected input costs being reflected in that margin contraction that you were talking about. So something to keep an eye on there. I want to shift quickly to your sector outlook. You made a couple of changes recently. Two big sectors in the U.S. market that are both somewhat policy and administration adjacent. You all are pro financials and maybe a little bit more hesitant on healthcare. I wondered if you could just highlight the reasons for both of those things for us.
Yeah, certainly. So on the financial side of things, the deregulation story is pretty widely known at this point. It's expected to help increase capital market activity. We saw at the end of last year, we saw a pickup in the financial sector earnings, driven a lot by pickup in capital market activity. And if you think about 2024, we wasn't even part of that deregulation story. So that is likely to come. I will say that there is one thing that you got to keep in the back of your mind is that if the Fed is kind of closer to the end of cutting rates than not, then that could certainly weigh on capital market activity. But overall, we continue to like the financials here. I'd say the other, just really as it relates to the healthcare sector. One of the things that I'm kind of watching is that over the last 15 years, there was just this general secular increase of spending out of Washington on healthcare overall. The tides appear to be shifting now. We're likely heading in the direction of less spending from a secular standpoint. Healthcare is obviously an area of focus for the upcoming tax bill. Some of the Medicaid in particular is one area that the administration is looking to potentially cut for spending cuts. At the end of the day, for the tax extensions, they have to find revenue areas to raise revenue, and healthcare sector kind of seems to be in the focus right now. I am cognizant of the fact, though, that margins, which had been in free fall for over a little over a year and a half, have begun to stabilize for the sector. So that is on the positive side of things in particular. And then from a valuation standpoint, if you just look at relative valuations of healthcare is kind of the one sector that doesn't have one of the massive exposure to any company that's really, trading at those elevated valuations. One point that I actually left off, when I was related to just talking about earnings growth, and I just thought of that's important, is that there has been a slight shift in the Magnificent Seven growth as well, more broadly speaking. I'd say 3 weeks ago they were expected to grow anywhere from 15 to 20% in the 4 quarters this year, and now you're looking at numbers that might be, say, 13 to 18%. So there is a subtle shift lower there, but that's in line with the broader market as well.
Yeah, so obviously a lot shifting with the new administration. So we're keeping our eye on different sectors, the earnings profile. Obviously, all of those fundamentals expected to drive more of the price action this year with valuation stretched, as you mentioned. So Ryan, thank you so much for the time. We'll look forward to talking to you again soon, and have a great rest of your day.
Thanks, Ross. Have a good one.